Thanks for tuning in to Retiring Well. We've got a great show lined up. We're going to be talking about, do I have enough to retire? Some of those different questions you need to be thinking about when you're planning for retirement. What about the sale of residence exclusion? What are those figures and how does that work when you sell your principal residence from a tax perspective? The three worlds of investments. This one's really interesting and you want to stay tuned for that. And lastly, how Social Security is being taxed. What impact taxes will have on you in your retirement plan. So stay tuned to Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
There's probably commonly two questions I get the most when people either see me out and about knowing what I do for a living here. And one of those questions is, do I have enough to retire? The other question is, what is the stock market going to do? Don't we wish we all knew that? But do I have enough to retire? And usually when somebody asks that question, they're referencing the dollar amount that they've saved in whether it's a 401k or maybe various other things. It's an interesting question, and I can tell you something from many years of doing this and helping lots of people achieve that goal is sometimes that dollar amount is irrelevant. Think of it, folks. In retirement, it's relatively simple. You have to have more coming in than going out. Just like when you're working and trying to earn a paycheck, you want that paycheck obviously bigger than your expenses, right? You want to have some money left at the end of every month. And so when you're thinking of that question, do I have enough to retire? That's where we have to do retirement planning, income planning, and the dreaded budget comes into play. You know, let's identify what expenses you have on a monthly or reoccurring basis, an annual basis, and then what are the other things? What are your goals for your retirement? You know, some folks get into retirement and their expenses may not be that great. Maybe their expenses drop from what they're used to. Other folks find themselves in retirement and their expenses actually rise. Now that they have time on their hands, maybe they're traveling more, maybe they're doing more with grandchildren and stuff like that. So really think about what that may be for you. You know, that lifestyle is going to be the biggest part because, let's face it, depending upon what you want to do will determine the amount of money you need. As an example, I've met with folks over the years that have little to almost nothing saved for their retirement, and they're living primarily on Social Security, or maybe they have a small fixed pension, and they're as happy as can be. You know, it's meeting their basic needs that they're doing. They're able to do the few things that they want to do on that budget. On the other side of the spectrum, I've met with folks that have multi-millions over the years, and we have to tell them that they can't retire because they don't have enough yet. Because when we do those budgets, when we look at spending, they're spending much more than what the income is going to be able to produce over their expected lifetime in retirement. Also, a thing that may play a role in that, what is your medical situation? What insurances do you have? What other like long-term care sort of stuff comes by? Life expectancy. All of these things we have to highly consider when we're looking at that question. So if you're sitting there wondering, do I have enough to retire? Maybe, maybe not. Let's talk about that though. Give us a call at the number on the screen. We'd love to sit down with you, talk about all the various aspects, figure out what your goals and aspirations are for your retirement, and help you develop a plan so you can retire well.
Welcome back, folks. What a topic there. I mean, that is the ultimate question, right? We get asked this every single day. Do I have enough money to retire? And what it really boils down to is income versus expenses. Do you have enough income to meet all the expenses? A lot of clients, they come in and maybe they haven't determined what that budget is and what it looks like in retirement. And that's really the first step. Figure out what your expenses are, and then we can map a plan to meet those. Most people, when it comes down to how to meet those expenses with income, we're looking at what their guaranteed sources of income are, whether it's Social Security, or maybe you're blessed enough to have a pension nowadays. So we account for that, and then we look at the total portfolio value. I know we've probably all heard that 4% rule, right? So if you have, let's say it's $500,000 saved for retirement, general rule of thumb is you pull no more than 4% off of that. So that would equate to what? A 20% rate of pull. Does that rate of pull plus your Social Security cover your expenses? Well, that's what we got to figure out, right? That's the name of the game.
For sure. You know, when clients come in the Cadillac office and they flop down their statements and they want to right away show me a number of what they've saved up. They want to show me how many digits they have before their decimal point. I always have to slow down a second and say, well, let's first talk about what are you trying to achieve in your retirement? What do you want that to look like? Paint me a picture. After they paint a picture, then we can start getting into what their cash flow looks like. As Nick said, what are your predictable sources of contractual income? What are your liabilities? What's going to be going out each month? As we get a better picture of that, then we can start talking about how you might be situated from a healthcare standpoint. What does that plan look like? We also get to look at your tax plan and the different taxable buckets that you can pull from. And as we organize all of that stuff, that's how we get to answer that question, can I retire? Because there's, you know, a lot of times there's worry when it comes to changing a lifestyle from working to not working. And so it's a question that we get asked often. We love to answer it. There's just a lot of components to it that we want to take into account. Hope you found that valuable. Hey, stay tuned. Next, we have the sale of your principal residence tax exclusion we're going to talk about in the three worlds of investments.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
When does a Roth IRA conversion strategy make sense? Check out our free instant download of the Wealth Report at sen-wealth.com regarding Roth IRA conversions to help you plan to retire well. Find out what the Roth IRA conversion rules are and what scenarios are beneficial from a tax perspective. To receive this instant download, simply visit sen-wealth.com, scroll down, and click Download Now to receive your copy of the Wealth Report. Simply visit sen-wealth.com.
Hi, my name is Jack Klunder, and I am a financial advisor with Centennial Wealth Advisory. I work out of our Cadillac office, and we specialize in retirement planning. We take a very holistic approach. We start with investments and see how you're situated there. We do wealth management. We do income planning. We do tax planning, any kind of healthcare issues or needs that you might have for insurance. And then we talk about what your legacy plan might be. So if you are nearing or in retirement and you have questions that you want to go over, please give the number on the screen a call and we can have and set up a free, no obligation consultation.
Let's talk about the sale of residence exclusion. So you own your home and here you are excited, okay, I'm ready to sell that home, but what are the potential capital gains and how would that work from a tax perspective? So if you're a single taxpayer, you can exclude up to $250,000 of gains, and if you're married, that equals $500,000. So again, this only applies to the gain on the sale of your property. So let's say, for example, you had a home where you're single and you've bought it and invested $250,000, then okay, you could sell for say upwards of $500,000, realize this $250,000 of gains, and that would be excluded, so you wouldn't have any tax implications. The old rules, you used to defer the gains as you would buy and sell properties, and then at age 55 there'd be a one-time exclusion. So all those old rules have gone by the wayside. Now when you sell your property, there's a 5-year look back to determine if that's been your principal residence for at least 2 of the past 5 years. So you have the ability to do this where you buy and sell properties every 2 years. But question comes up sometimes, what if we had a second home? Maybe a vacation home that you'd use. It's a possibility where as long as it's been your principal residence for at least 2 years of the past 5 years, then you'd be able to exclude it. Now, However, rental properties, whole different ball game with that. If you've been depreciating that rental property and getting a tax deduction over the years for that, it's not necessarily going to work. The IRS caught on to this, and they're going to be looking at essentially how much of the property you've depreciated, and they want to know how many years you've been renting that property. So as an example, let's just say you moved into that rental property and you've been in there 2 years of the 20 years that you've owned it and been renting it out. So essentially two of the 20 years, that was the case, so you'll have a 10% exclusion. So again, single taxpayer, maybe that's $25,000, married taxpayer, that's $50,000 of taxable exclusion. Vacant land, if that's contiguous to your existing principal residence, then again, you would be able to apply this. So the equation for all of this is again going to be your sale price minus the purchase price plus improvements and plus closing costs is going to get you to whatever that taxable gain is, and then you subtract that exclusion. Hope you found this helpful as hopefully you're enjoying real estate and the joys of owning it.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time we'll have reports that show us the percentage of assets currently in high-risk vehicles as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
When it comes to your financial future, what's the value of a truly objective opinion? As someone looking for financial guidance, you have choices. There are thousands of captive financial professionals who work as employees for large national insurance companies and brokerages. There are also many independent financial professionals who aren't bound to any given insurance company, investment strategy, or product. So what's the difference, and why does it really matter to you? Consider this. If you walked into a doctor's office with a sore throat, a bad cough, and a high fever, you'd expect that doctor to assess your symptoms, do a thorough diagnosis, and ultimately hand you a prescription written to cure your particular ailment. In other words, you'd expect the doctor to consider all the medications available and give you his or her absolute best thinking on what's best for you. On the other hand, if that doctor opened the cupboard and only had 3 or 4 prescriptions available, maybe those offered by his or her favorite pharmaceutical rep, most patients would immediately raise an eyebrow, suspicious that they might not be getting what was really in their best interest. The same may be true for your financial well-being. If your financial professional is an employee who's contractually bound to represent a given insurance or investment company, only offering their products while there are literally hundreds of others available, how sure can you be that you're being offered what's truly best for your situation? You don't walk into a tailor or seamstress shop to get clothing off some rack. You go for a custom-tailored fit. And with something as important as your financial future at hand, the stakes are even higher. We believe you deserve a truly objective opinion. We think you deserve to consider more of the available options, and we believe your financial future is worth a custom-tailored prescription to help you feel confident for the days ahead. If you'd like a second opinion on your current retirement strategy, simply contact our office today.
As an investor, you have tons of options out there to invest in. There's various different markets you can invest in, various different products you can invest in, but pretty much when you look at the world of investing out there, we can boil them down to probably three primary buckets, or three worlds of investment, we call it, that those are going to group into. The first, let's simply call it the world of the knowns. These are products out there and investment tools that basically you know the desired outcome, or what the outcome is going to be. Typically, let's think of like a bank has their version of these. Think CDs, savings accounts, such like that. You know the interest rate, you know the term, and you know that there's not a risk of loss due to market fluctuations and stuff like that. That's an example, right? We know what we're getting. Insurance companies have their versions of those as well. Some forms come in forms of annuities. Maybe it's a fixed annuity, fixed term, fixed rate, and the guarantee of no market losses, right? So you know going in, once again, what you have. Government has their terms of that. Government bonds, right? They get issued various different bonds at different years and terms, and also with a rate going in, right? So once again, world of the knowns. We know what we're getting on multiple levels. Now let's go to the other side of the spectrum, the world of the unknowns. This is commonly, think of like a stock. We know a portion of it, right? We know the quantity we're buying. We know the company maybe we're buying, but we don't know the outcome. We hope it's a certain way, or maybe when we do an analytics of it and we look at all the factors, we believe it's going to be a certain thing, but there's an element of the unknown there, right? Those are that. Insurance companies have their version of the unknown as well. Variable annuities. Once again, they have sub-accounts, and those sub-accounts are typically tied to some sort of indices or funds. And once again, they have a varying performance level. We may know the term of the annuity, but there's certain unknown factors of that in there. So then, what is the other third bucket out there? Well, we call it the hybrid. It's a mix of both worlds. Think of it, once again, on the insurance side. Fixed indexed annuities, let's say, an insurance product. They have the term, we know the term, and we know that there's not going to be market loss, but our performance is tied typically to some indice. Let's say it's the S&P 500. Market goes up, or S&P 500 goes up, we usually get to participate in some of that. If it goes down, there's some safeguards in place where we don't have market loss. That's through insurance companies. Banks have a version of the hybrid world too. Equity-linked CDs. Similar to what I just talked about with the fixed index. Once again, element of safety, we know the term, but they're tying your performance to some index over time, so that way you have that element of unknown. There's some safety there once again, because there's some stuff in the contract where we can't go backwards, but there's an element of unknown. So for you as an investor, I believe it's vitally important that you understand what you have, and is that appropriate for you? Are you in the right world that you should be in, or should you be maybe in multiple ones of them? So for diversification, depends on your situation. So if you're out there and maybe you don't know what you have or wondering what you should have, give us a call. We'd love to walk through that with you and help you plan to retire well.
Hey, welcome back. Hopefully you got some good information on a couple hot topics there, things that we always want to be aware of when it comes to retirement planning. I'm going to talk about the sale of the resident exclusion, that tax exemption there. I just had recently a client come into the Cadillac office, and it was time for them to downsize. They had a beautiful multi-room, multi-bathroom house, and kids were gone, and they just needed a simpler place to stay. So they were able to sell their principal residence, take advantage of some great tax savings on those capital gains, and bought a condo. So they were asking, hey, what should we do with these excess gains now? And so we started trying to figure out, okay, well, what's the purpose of these? Well, as we discovered, they had a fairly large amount of money in tax deferred accounts. And I asked them, I said, well, what's your tax plan? And they said, I don't know. So I said, well, let's work through that. And as we started mapping out a long-term tax plan, we decided maybe it's best that we use some of the proceeds from this sale of this house, these after-tax dollars, to help pay for those Roth conversions. As we mapped it out and they got to see the advantages of doing that, it made a lot of sense. So if you're somebody that might be thinking about downsizing, or you sold your house and you want to know what to do, if you have any questions, feel free to give us a call. We get to lead with education, we get to teach first, and it's super fun. So feel free to give us a call. I know, Nick, you get to talk to
Great example there of that. They also talked about the 3 worlds of investments as well. So when I think of that, I go to investment returns, like known returns versus unknown returns, and then there's also investments out there that have a hybrid combination of that. So an example of like a known return would be your typical CD at a bank. Hey, that's going to return X amount. Given where we're at today, not much, right? Then you have the unknown. So anything in the market, really. I mean, it could go up, you could have a really good year, or you could have a bad year. Well, there's also products out there that are hybrid, that take a combination of both of those, and it's annuities. But that's something where we can educate you on the benefits to all those different worlds of investments and figure out which one makes the most sense for you. So hopefully you found that very valuable. Please stay tuned. We're going to be talking about how your Social Security is taxed coming up next.
The stock market has a natural life cycle that is destined to encounter peaks and valleys. Those scenarios are frequently preceded by events such as changes in interest rates, new international trade negotiations, treaties, and tariffs, fluctuating levels in the national debt, global events that threaten the economic stability, political controversies that impact national policies, dramatic news headlines that shape investor sentiment. While each of these issues, and certainly all of them combined, generate cause for concern, it's important to remember that we have been in similar circumstances before. One way to help gauge market-related anxiety is to consider observations made by renowned investment experts who have weathered many markets' ups and downs over the years. Contact us today for a complimentary portfolio risk assessment. We'd love the opportunity to help you plan to retire well.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Are you nearing retirement or in retirement? Have you had your portfolio just looked at or have a second opinion on that portfolio recently? Centennial Wealth is a full-service advisory firm, and we have multiple locations in Northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no-obligation consultation, so just call the number on the screen.
Let's talk about how your Social Security is being taxed. So essentially you're going to take half of your Social Security plus all other taxable income is going to equal your modified adjusted gross income, or MAGI. So if you're a single taxpayer and you run through that equation and you reach the parameters of $25,000 to $34,000 for your MAGI, then 50% of your Social Security is taxable. If you go above $34,000, now all of a sudden 85% of your Social Security is considered taxable income. For a married couple, those numbers are $32,000 to $44,000. 50% of your Social Security is taxable, and then if you go north of $44,000, then 85% of your Social Security is taxable. So again, you're going to take your taxable income plus your taxable Social Security to determine your total taxable income. Now, with total taxable income, you can then determine sort of what tax bracket that you fall into. But you don't want to forget that you have your standard deduction that's going to be deducted from that figure. So let's walk through an example. Let's say you have a $20,000 IRA and $24,000 of Social Security. So half of $24,000 of your Social Security is going to be $12,000 plus $20,000 of your IRA equals $32,000. So if you're married, then none of the Social Security is going to be taxable. So you're left with a $20,000 IRA. The standard deduction right now is essentially close to about $26,000. So that's going to offset all of this income. So in this example, if there's maybe $44,000 of income with $32,000 of Magi, but $0 is taxable, now that's where you have an opportunity to start looking at what are some ways that you should be taking advantage of the current tax brackets and try and optimize those. So understanding exactly how Social Security is taxed and what role it plays within your overall retirement plan can be valuable, because there may be opportunities where you could draw additional funds from IRA, either as withdrawals or potentially as Roth conversions, to optimize your current tax bracket. Here at Centennial Wealth Advisory, looking at that long-term plan for not just for your income, but also for your tax plan, and also Social Security planning. When to begin Social Security is vital. So we encourage you to give us a call. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit to dive into this a bit deeper.
Hey, welcome back. I know this is always hopefully helpful that you get to figure out how am I going to get taxed, right? Death and taxes are two things that are coming your way. So let's know about them and learn. So I did a little digging and went down to some of the history of how Social Security was taxed and what thresholds were in place. And so back in 1983 was when they were first introduced as having some of your income benefits from Social Security count as taxable income. They set these different thresholds, as you saw, for whether if you're single or married, as to what those income thresholds would be before certain different parts of that income would become taxable. And what it reminds me of is what we see all of the time. How tax diversified are you? We have a lot of clients that come in and they'll show us all of their statements and they'll be diversified in their investments, but they'll be in one, maybe two buckets of their tax accounts. And so as we start addressing that tax plan, then what happens is always, the Social Security tax plan comes into place. Do we need to file now? Do we want to wait to file? Do we want to do some other tax planning before we start? When we do start, what kind of thresholds do I have to be aware of? And so I know, Nick, you had some specific examples, right?
Yeah, I mean, mine is more in reference to health insurance and how that was affecting their Social Security as well. So this couple came in and they understood how much of their Social Security was taxed. And their situation was about 50% of their Social Security was taxable. And so what they thought is, because they were under the age of 65, they were applying for marketplace insurance through the Affordable Care Act, and they thought, well, they only had to include 50% of their Social Security because that's all that was being taxed. Well, that is not the case, right? For that Affordable Care Act, you have to include all of your Social Security. So it's just so important to get somebody to help you plan for all these different scenarios that are out there. You don't know what you don't know, right? So hopefully you found that valuable. Please tune in next week, same time, same station.